Good morning, everyone. This is Financial Literacy One-on-One. And today, we'll essentially be conversing, we'll be discussing that I essentially have been investing the wrong way. I've been investing in call options versus put options. And I'm going to show you my history very, very quickly here. As we're looking at my history, you can tell that I had a plug option. And plug dropped down to $39.36. We're essentially in a long market correction. They have not yet labeled it a recession or even a mini depression. And then also, if you guys have been following me, I've been losing rapidly when it comes to Tesla, especially with this particular option. With this particular option, I lost $7,000. Believe me, it's a hard pill to swallow. Now, if you can tell right here, that my call option was $852.50, but Tesla dropped down to under $600. So I got zero. So essentially, I put $7,000. Listen to this. I put $7,000 into an option and I got zero return of my investment. And that is absolutely 100% all of my fault. Also, I lost about $1,200 on my plug option. So altogether for the last month, ladies and gentlemen, I have lost around $8,000 total. And it's because I've been investing the wrong way. And here's why. I am buying call options versus put options. I knew the indicators. I knew the trend. So either one or two you're going to do. You're going to invest in a call option. Take you way out of April or May so you can kind of dictate how the market is going to move. Or you're going to buy call options, put options that essentially gives you the time and the room and also the predictability in order to make some money. Now, me personally, I thought the market, again, I didn't do the research. So I'm giving you that information because even myself, I make very uncommon mistakes of a person who invests a lot, but I'm just letting you know I'm being real with you. Okay. So when it comes to options, I'm using Heckler Mine. Okay, we're looking at Heckler Mining Company, and this is where I'm essentially just going to briefly show you how it looks on the Robinhood platform. So again, as I'm looking at Heckler Mining, the particular price point right here, if you guys can see this, is around 93 cents a share. So I'm in the call option platform here in this interface. So I'm going to switch it. So I'm a buy, but I'm going to switch it to put. Everything's going to turn red or pinkish, okay? Then right here it says March 12th. So March 12th, even for a put option, even in a down market, buying an option so close in its expiration date is very dangerous. It's very, very risky. It doesn't give you any maneuverability, any wiggle room to make decisions to change this option, okay? The way this option is essentially structured. So what I'll do is I come down here and say, okay, well, it's March 12th. I at least want, maybe a month or two out. So let's look for June 18th. Now, anytime you buy options so far off, they're going to be expensive, okay? Anytime you buy options so far off, 2, 3, 4, 5, 6 months, they're going to be expensive, but you have a better chance of winning because all the fluctuations in the market. So taking point, if I would have bought my Tesla option for, let's say, June, right? So essentially, let's say for June, and then I would have essentially lost all of that $7,000, but Tesla will climb back. Now, most people are predicting in the next month or two because Elon Musk has been doing a lot of very unconventional things with Tesla. So he closed down a factory, which actually hurt the stock. I don't know I think it was a vehicle factory. I forgot the location, but nonetheless, it really hurt stock tremendously. So you got to give the stock market time to rebound. Options is going to be your number one most lucrative return in a very, very short period. Most of us, we buy 10, 20, 50, 100 shares of a particular stock. And when the stock market is doing good, we see a good return. But then when the stock market goes down, you see a down return. Now, we know as investors, we hold our investments. We don't just sell them to sell them. Like, yeah, you're going to sell your investment if you are essentially inside of some business deals and you need more capital to venture this business deal. Okay, that's cool. There's an emergency in your family or with yourself and you need to sell off some of your assets. So you do that. But most investors stay in the market, regardless it's an up market or down market. What they do is in a down market, they buy. Okay. And they also do call options. In an upturn market, they slow down their buying. Okay. And they might lean towards index funds, bonds, and also ETFs, which is a really good strategy. And even during that time of a down market, it's really good to buy precious metals, believe it or not, because gold, silver, platinum, palladium, copper, all of these particular ones actually are becoming more rare. So the more rare that a precious metal occurs in nature of someone finding it, the more value it has. So like me, I actually have gold and silver inside of my safe in my home. So people who know me also have guns, so don't try to come rob me. But nonetheless, the reason I'm telling that, because at the end of the day, let's just take, for instance, the financial markets crash. What do you think is going to be left to trade currency? It's going to be silver most likely. And if you look at African and like 14, 15, 1600s, whether it be the Africans or the Europeans, people were using more silver than gold because only rich people had gold. But let's really break down, and this information is mostly coming from investopedia.com about the differences of call and put options. Now, I'm going to tell you in a very layman's term, call is you banking on the market and your particular option going up, and put is you banking on that it's going down. Either way, you're trying to bank on that information and your investment in order to make money. So according to Investopedia, it says an option is a derivative because its price is intrinsically linked to the price of something else. If you buy an option contract, it grants you the right, but not the obligation. It grants you the right, but not the obligation to buy or sell an underlying asset at a set price on or before a certain date. And it goes on to say, a call option gives the holder the right to buy a stock, and a put option gives the holder the right to sell a stock. But they're interchangeable, okay? They're simultaneous. So it doesn't matter. You can do both with both, all right? You can sell or buy, vice versa, okay? Think of a call option as a down payment for a future purpose. So I'm gonna give a very, very quick example that they have right here on Investopedia. So bear with me, but it may give you a better understanding than what I'm trying to explain to you. So call option, it says the homeowner sees a new development going up. That person, let me share this with you guys in case I missed something that you guys may want to see. Give me 1 second. And let's bring with you guys. There I am. Okay. And it says here, let me go back up just a little bit. Give me 1 second. Right here. It says a potential homeowner sees a new development going up. That person may want the right to purchase a home in the future, but will only want to exercise the right once certain developments around the area are built up. So like you see a new development, you want to buy a house, but you're like, I want to buy, but I want to see what these guys actually put up. Are you going to put a Walmart or a Dillard's up? You know, it's certain stores and certain business districts will increase or decrease the property value over time. So that's what they're trying to say here. Then it says the potential home buyer will benefit from the option of buying or not. You have the potential option of buying or not buying. Imagine they can buy a call option from the developer to buy the home at a, say, $400,000 at any point in the next 3 years. Well, it as a non-refundable deposit. Naturally, the developer will grant such an option for free. The potential home buyer needs to contribute a down payment to lock in that right price. Essentially, when you go and buy a contract, every contract is a fraction of the share price at a decimal rate of 10. So you're only buying a fraction for the option to buy those shares at the full price, but at the set price you went in the option for. So let's say a share of Heckler Mining. We use Heckler Mining. The ticker for that is HL. Let's say each share was $6. Okay, $6 per share. So each contract is 100 shares per. So you have to do a decimal point rate of 0.10. So essentially, you're only going to pay 60 cents on the dollar, 60 cents for that option per share of the 100, meaning that you may only pay what, $60, correct? And it depends. Now, the price also moves when you talk about the certain expiration date and how long it's going to be far out, et cetera, et cetera, et cetera. Let me move on. It says with respect to an option, this cost is known as the premium. It is the price of the option contract and home example. The deposit may be $20,000 that the buyer pays the developer. Let's say 2 years have passed and now the development are built and zoning has been approved. The home buyer exercises the option and buys the home for $400,000 because that is the contract purchase. Okay. Now that's very important that we understand that really small example. So I'm going to go back. Okay, I'm gonna go back to Heckler Mining so we can look at the prices as they change when we push out the expiration date, which is very imperative in this example for you guys to understand option trading. Because again, I made a large mistake. I knew that the market was trending down, but I was banking on the market in the next 2 weeks to a month to actually do an uptrend because of what? Indicators, analysis, and mostly headline news. So now watch the market. Watch the market on Monday. Now that the Democrats said that they passed the 1.9 trillion America relief bill or whatever stimulus package is included with that as well. I'm expecting the market to go up next week. I am. So I bought what option was that? We'll look at it. Let's look at it very quickly. So here we are right here with Heckler Mining. I'm going to show this quick example and I'm going to show you what option I bought. Okay. Cause I was up to 41 grand in my portfolio, guys. Then I'm down to 23,000. That's because I lost like 8 grand and plus some other things, but nonetheless, I digress. Okay. But anyway, we're looking at Heckler Mining. Here's that $6 example right here. So it's $6, but look at the expiration date. So let me show you, if I go to a very volatile expiration date, like March 12th, which is next Friday. Look at this. Look how much one option per 100 shares cost me, right? Watch this. $35. $35 for an option to buy 100 shares at the current share price. But for this option to buy or option to sell, you're only paying a fraction, okay? So one of the key indicators that I look at for option trading, first and foremost, is the implied volatility. And if you guys can see this right here, implied volatility, they're saying, hey, it's basically a 90% chance. Listen to this. It's a 90% chance that you'll do good or you'll do bad. Like this is the most irrelevant, but most relevant indicator of you making or losing money. But I am going to do a video probably next month and I'm going to explain the Greeks. Some people just look at this and they bypass the Greeks, but this is very important of when and at what time frame and the fluctuations in the market, when to sell or buy an option, when to sell or when to buy an option, the Greeks. Now, let me show you how the price changes as I change the expiration date. Okay, let me get rid of this. Give me 1 second. So let's go to $6 again. Now I'm gonna push this out to say, let's go back to June 18th. Now look at the option for $6. Now it jumped up to $1. Now let's see, per contract is going to cost me $103. That is 3 times more the price that we were looking at before, because again, you have a better opportunity to make money. So it's not as risky as buying it if the option expires next Friday. You need that wiggle room. Is it worth it? I absolutely believe so. But again, this is a option for a put. Now I'm going to just simply change it to call, because now we're saying, oh, the current price of Heckler Mining is $5.93, but I'm thinking by June it has to hit $6. Watch how it changes. Here we go. Now we look at 690 is the break-even price, and then to break even price, and then to break even, you need around 16.3% of an incline in order to do well. Now, the price here came down because Heckler Mining is actually on a downturn. So they're looking at, well, the chances of you making that money is a high probability. So we're going to make that option contract even less. So let me do one more thing. Let me erase this. And I'm going to buy a contract. or essentially show you a contract, is $193. You see how that changed rapidly? So again, you need to understand the way option trading work. And believe me, the money, if anything, if you are a novice investor, okay, if you are a novice investor and you're trying to get into option trading, there's one tip I can give you. I don't really care what you buy. I mean, you should care what you buy. And you should be reading their news. You should be following that stock. But the one thing that you need on your options are time. Don't do what I did. I bought that $7,000 Tesla option. And I think I gave myself like a month or two. And we have to understand that some stocks are more riskier than other stocks. And if anybody's been investing in Tesla like I have, the one thing I know is Tesla, by the ways of Elon Musk, is 1,000% unpredictable. And I should have done at least a 3 months, because if this stock reaches over 85, $852 and a half or $853 in the next month or so, I'm gonna kick myself in the ass every day. Just like I did when I sold 200 shares of my Citigroup stock when the recession happened back in 2009. I essentially lost off on thousands of dollars again. But anyway, I'm learning from my mistakes even now, and you need to learn from my mistakes so you don't make the same mistakes. And the reason why I give you this information, because it's imperative that you're learning from me and you're not learning from yourself, because a lot of us don't just have money to lose. I don't have money to lose, but damn it, $8,000 in a month. That's not, ladies and gentlemen, that's not fun. All right. We're going to quickly look at my portfolio and look at the option that I just bought with GE. I don't know if you guys saw my GE breakdown, but we're going to go over GE very, very quickly. Okay. So right now we're looking at GE. I'm not going to get into the particulars of GE because, again, I just want to go over my contract. Again, the contract I have is one contract. The break-even price is $14.34. My average cost per share is 84 cents. But now I am down a negative 2.38%, and my total return is a negative $2. Okay. But this option, okay, is a month out. Now, the reason why I did a risky option is based upon how the market is moving. Okay. The way the market is moving. The market is moving because of the stimulus package, and we should see an upturn in all of these price points. So if you guys have any questions, I don't see anyone really chatting this morning. I think people are just soaking it all in, thinking about how much money I lost. And I'll show you now. It's not going to show you verbatim $8,000, but you have to do the math essentially. But I'll show you how my portfolio has changed. Okay. So we're looking at my portfolio right now. Hopefully everybody can see that. I'm working on one screen over here in Rio de Janeiro, Brazil. But nonetheless, I'm going to go to 1 month out. Okay. 1 month out. You see right there a negative right here, ladies and gentlemen, $5,300. So let me go 3 months out. Okay. They say I made some money 1 month out, 5,300, 1 week out. There's another 1,600. But I did the calculations, ladies and gentlemen. Believe me, it was $8,000. Now I made some of that money back, but don't forget my option contract totally wiped away my 2 option contracts from Plug Power. And also Plug Power and Tesla wiped away $8,000 totally from my whole portfolio. That's not even being computed. Okay, it's not even being computed in the amount that I've lost. So when you look at it, ladies and gentlemen, let me show you this. Okay, here's my year. Let me show you how much I was up. Look at this. I was up, believe it or not, to 41 grand. Look how much I made in the past year. Underneath that 40 grand, that 41 grand, you'll see $28,677. Then, I mean, you take away 16 grand. What do you get? You get around what? $23,000. So when you look at that, that's what I'm saying. When I lost that money in the option contract, that was $8,000. That was $8,000 that totally was wiped away from my earnings or my losses in my portfolio. Then I'm still down another $8,000. So hopefully I can at least get back to 30 grand. I actually paused all of my investment. What I was trying to do, I was reallocating my portfolio. I said, well, let me get out. I'm actually out of NEO. The information I gave you, I'm actually out of NEO, and I'm still in Plug Power. Now, I did some dollar cost averaging. I'll say, well, you know, was it a smart idea to actually totally come out of NEO? I'm still debating that with myself. NEO has the last quarter was pretty bad. Their quarters prior to that, they was doing more than what they said they was going to do. So their stock almost went up to 60. I think it went up to $59 per share. So now I'm contemplating, should I go back in and invest, I don't know, maybe $1,000 or $2 inside of NEO and buy it at this price point, predicting that it will go back up to $60, dollars a share. But I don't know. But I'm just letting you guys know this information because I've been investing the wrong way. The past month or two, I should have been buying put options rather than call options. This is Financial Literacy 101. Learn money and be inspired. But the key word in this is learn money. You guys have a great and wonderful day. You take care of yourself. I'm out.